Hey guys, and welcome to another episode of Geeked for Managerial Accounting. Today I'm going to be talking about chapter 3, which is cost, volume, profit analysis. Now in this chapter, what you really need to know is a couple of formulas and how to apply them to certain questions. So in this first video, I'm just going to cover all the formulas, how to calculate them, what they and what their uses are basically. All right, so we're going to get started with the first one, which is contribution margin. All right, so contribution margin is basically your selling price minus your variable cost. In this case, I want your contribution margin to be per unit, and respectively your sales price and your variable costs are per unit as well. Now, for example, if you have a selling price of 20 for a certain product and the variable cost is 15, you should arrive at a contribution margin of $5. Now, what does this $5 of contribution margin mean? And what does it tell you? So basically, this $5 that is left over is only after incorporating the variable costs relevant to your product. All right, you haven't incorporated any fixed costs into this, so you still need to pay fixed costs, right? So this $5 is basically to pay off any other fixed costs that you may have. In short, contribution margin shows you how much money you have available to pay off your fixed costs. All right, so I'm going to just make up an income statement and I'm going to show you what I mean. So in this case, sales are $1 million and your variable cost is 500,000, so your contribution margin is 500,000, right? So then if your fixed cost is 400,000, I'm left with a profit of 100,000. And do you see why? It's because my contribution margin exceeds my fixed costs by 100,000, right? For example, now if my fixed costs were 600,000, I would have a loss of 100,000, right? So basically, again, contribution margin, I can quickly look at it and I can see if I am capable of paying off my fixed costs. All right, that's the main use of contribution margin. Now, if you want to find total contribution margin in a question, what would you do? Well, you would just take total sales minus total variable cost. You would just multiply your selling price by units and your variable cost by units to arrive at a total. And it makes sense because total contribution margin should be total sales and total variable cost. Okay, so that's it for contribution margin. Now we can move on to break even. So what is break even? So break even is basically when you sell enough units to neither earn a profit or incur a loss. All right, at the break-even point, all your costs are covered. So basically, your sales are just enough to cover all of your costs. All right, so what would your profit be when you break even? If someone tells you we have break even this year, what are they saying in short? Well, they're saying that your profit is $0. That's what break even means. And now to calculate break even, there are in units, you have to remember the following formula. In units, all right? So you take your fixed costs and divide them by your contribution margin per unit, all right? So again, over here, remember the $5 that I found here, selling price minus variable cost? This is your per unit contribution margin, and that's what you're going to use over here. So for example, in this case, if we have fixed costs of 400,000 and our contribution margin is $5, what would be 5, 8, and 80,000? I hope I'm right. All right, so 80,000 would be, sorry, 8,000 units, my bad. This is 80,000 units. So you would have to sell 80,000 units with selling price as 20 and variable cost is 15 to arrive at break even. Basically, you sell 80,000 units just to make $0 of profit, right? And another way that you can present break even is break even in sales or dollars, all right? This was in units. How would you get the break-even value in dollars? Well, there's actually two ways to go about it. For example, the units that I found here, you can simply multiply your units by your selling price to get break-even in dollars. So if I do, if I do 80,000 times 20, what would that be? 80,000 times 20 is 1,600,000. So that's your break even in sales dollars. Okay? And another way that you can find break even in dollars is by dividing your fixed cost by your contribution ratio. Now, contribution ratio is selling price minus variable cost and the whole thing divided by selling price. All right? So you can choose to go with any formula. It's your choice, and I'm going to show you that you're going to arrive at the same answer. So 400,000 divided by, and then we're going to do a separate calculation here. So 20 minus 15 divided by 20 is what? So 5 divided by 20 is 0.25. How stupid of me. So 0.25, right? So divide 400,000 by 0.25 and 400,000 divided by 0.25, you get the same answer. You get 1,600,000. So you can see over here that both answers are the same. I just use a different way to do each. Now you can choose to do whatever you want in the exam, unless the question asks you to do it a certain way. All right? So that was break even. Now we're going to move on to a formula that I want you guys to remember. So in the textbook, there are two formulas that are going to ask you for a certain level of sales. It's a fixed cost plus target net profit divided by something. I don't even remember it anymore because I never used it. I didn't see the logic behind it, and I'd advise you guys to remember the following formula, which is much more logical. All right, so sales minus variable cost minus fixed cost equals profit before tax. Right? That's straightforward. And then that profit multiplied by 1 minus your tax rate equals to net income. Now, as you can see, it's very logical. Sales minus your costs gives you profit. Profit times your tax rate, whatever it is, then you arrive at net income. Net income is always net of any taxes. All right? So it's very straightforward, it's very logical, and I'd highly advise you to remember this formula. In a later video, I'm going to do a question and I'm going to show you how to actually apply this formula so you don't really have to worry about it. All right? So for now, just bear with me. Okay? So the next formula is degree of operating leverage. Now, so degree of operating leverage is basically contribution margin divided by your profit. And if you want to break it down further, I like to remember it this way. It's selling price minus variable cost divided by selling price minus variable cost minus fixed cost. I just like to remember it that way. Mind you that it's not going to be selling price minus variable cost. It's actually going to be sales minus variable cost, like total variable cost, because you have a total here. You have a total fixed cost over here. I just like to break it down this way, but essentially you're going to have to take totals for contribution margin and totals for your profit. Okay, so degree of operating leverage, what does it really show you? So degree of operating leverage basically shows you how much your profits change when sales do. So it shows you the sensitivity, if I may, of profits in response to a change in sales. All right, so if like your sales are going up or down, you want to see how much effect they might have on your profits in the future. Like for example, sometimes you create sales budgets, you see that your sales are falling drastically, you want to see if you're still going to make a profit on that level of sales. So that's the main use for this. And finally, the most easiest formula is your margin of safety. So margin of safety is basically your budgeted sales or your current sales minus your break-even sales. Okay, so margin of safety, I can illustrate it with a diagram. So this is, remember, this is called a CVP graph, a cost volume profit graph. You may be asked, you may be tested on it, so it's good to know how it works. So now I'm gonna go step by step. So I'm gonna start off with sales. So sales start off at 0 and they rise as your units rise. Am I right? So far so good. And then your fixed costs, remember from our previous chapter, start off here. That's a bad line, 1 second. There we go. And your variable costs, variable day start, well, they would go like this, because remember, you still have to pay this minimum fixed cost before your variable costs start going up. Alright, so variable cost will start off where fixed cost is on the y-axis. And this is your sales, this is your variable cost, and this is your fixed cost. These are your units, and these are your dollars. Okay? So now over here, this intersection of sales and variable cost is your break-even point. See, it's much better to illustrate it and see what actually goes on in a break-even point. Now this area right here, this triangle below the break-even point, if your sales are anywhere in this area, you're gonna have a loss. And if your sales are in this shaded area over here, you're gonna have a profit. Now the area that I've shaded over here, this is called your margin of safety. Now margin of safety, the implications of margin of safety basically are that you want to see how much your sales can drop or how much your demand can drop before you experience break even or even loss. So if you have like a high, like a big margin of safety, you can actually experiment with your demand, you can try to bring new products onto the market, you can play around basically with your demand. But if you have a small margin of safety, you want to be careful with your demand. You don't really want customers to go away and leave your business, because it's already very hard to retain customers. So basically, margin of safety shows you how much risk you can take in your business. Alright guys, so that's about it for the formulas bit, and in the next series of videos I'm going to do a proper question and I'm going to show you how to apply some of these formulas. Alright, stay tuned guys.